Earnings season is still underway, and there are tons of opportunities out there for powerful one-day trading opportunities that are easy to learn. I'm Seth Freiberg, the head trader of S&B Capital's options trading desk here in Manhattan. And the traders on our desk make a lot of their money during earnings season and are always looking for new ways to take advantage of the explosive price movement that normally accompanies earnings releases. In today's video, we're going to teach you a strategy that takes advantage of how options respond to imminent earnings releases, and more importantly, why they work. So if that sounds of interest to you, then stick around because I think you're going to find this surprising. Hi, I'm Seth Freiberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and are in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so one thing that professional options traders understand well is that when a company is about to release its quarterly earnings report, the pricing on the options derived from these stocks get much larger than normal. And the reason for that is that the risk to the ones selling the options get a lot larger as earnings approaches. And to drive this home, I want to show you an example of just how dramatic that is through a recent Amazon example. Now, I want to do a really quick review of how stock options work so that everyone watching this video understands how they work. If you already know, just please hang in there. This is going to be quick, and then we're going to jump back into the heart of the lesson. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of his stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before the option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. In the case of a call, even if the stock's going way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, as to the put option, even if the market goes way below the strike price of the put option, the buyer of that put has the right to sell his shares of the stock at the strike price of the put option that he's bought, even if the stock has gone way below the strike price of that put, which effectively puts a floor on how much he can lose owning that stock. On the other hand, if on expiration day the stock closes below the strike price of a call, unless it was previously exercised, that call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. Okay, so now with that as background, let's go back to June 24th, and that date is almost random. We're just looking for a date very far away from any earnings release of Amazon. And Amazon normally reports its earnings during the latter part of the first month of each quarter. So they'll report in January, in April, in July, in October. And so June 24th is a full month before the next earnings date. And as you can see, Amazon was trading at $34.49 on that day. And so let's suppose that you pulled up an options chain on that day for options expiring on the next day, which is June 25th, and went ahead and sold 4 calls about 300 points above the market up at 37.50, and you bought 4 calls 50 points higher at the 3800 strike. And then you went 300 points below the market and you sold 4 put options 300 points below the market at the 3150 strike, and then went 50 points further down to 3100 and bought 4 of those 3100 puts. Well, if you did that, you'd be creating an options strategy known as an iron condor, where you sell calls and puts above and below the market and buy calls and puts farther from the market as protection, which is exactly what we did here. And because the short calls and the short puts are 600 points in distance from each other, this is known as a 600-point wide iron condor. Before we move on, if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Let's look at the cash flow of what happens when you do that. And as you can see, when you sell those 4 37.50 calls, you receive 18 cents per option. But remember, each call option represents the right to buy 100 shares. So you multiply that by 100 and you sold 4 of those. And so those brought in $72. But then for protection, you bought 4 of the 3,800 calls, which you can see from the calculation cost $64. You also received $144 for the 4 puts you sold and paid out $100 for the 4 protective puts you bought. And so netting it all down, you receive $52 for this trade. Now, moving to the next day, the day that these options expire, you can see that Amazon closed at 34.01. And so now the iron condor trade has expired. All those options have expired because June 25th was the last trading day for those options. So we can now value the options in our iron condor. And that's pretty easy because they all expire completely worthless, as you can see, because all the calls, both short and long, are above the market. So the owners of those calls get 0 for those on expiration day because no one will exercise their right to buy Amazon 350 points above where they're trading in the market. And similarly, both of the put positions are below the market. So again, they have no value, as we explained earlier, because no one is going to exercise their right to sell their Amazon shares 250 points below the market. And so all 4 options expire with no value. And all that's left is the original $52 of cash that you received for selling those original options as your profit. Now, let's contrast that to October 28th, which is right before Amazon released its earnings report pertaining to the third quarter of 2021. And as you can see, late in the afternoon that day, Amazon was trading at 34.46. Now, let's do the exact same thing this time and construct another 600-point wide iron condor with the short calls and puts at 37.50 and 31.50, and the long calls and puts at 3,800 and 3,100. And breaking down this trade, we can see that this time the cash flow is a completely different story. You see, right before earnings are released, sellers of options, even ones very far away from the market price, are the beneficiaries of huge increases in prices, because the chances of the seller of that option having an obligation to sell their shares of Amazon below market in the case of a call getting exercised, or having to buy the shares above market in the case of a put getting exercised, the chances of either of those happening go up substantially if the stock is about to release its earnings, because if the market totally loves the earnings report, those calls may actually be activated, even if they're 300 points away. And the same thing for the puts. If the market hates the report, because stocks have been known to move 10% or more on earnings, and so this is a real possibility on a $3,400 stock. And so when we look at the pricing on this slide, you can see that, for example, on the 37.50 call, we received over $1,700, whereas before we got only $72. Of course, as you can see, we're paying more out for our protection, the long calls and the long puts like we did last time. But when we net it all down, the amount received was $900, which is a full 17 times greater than the $52 we received when earnings were not imminent in the previous example from June. And so the next day, when Amazon closed at 33.72.40, each of the options again expired worthless. with the calls being over 300 points above the closing price and the puts being more than 200 points below the closing price. And so again, they all expire worthless, except this time the profit was 17 times greater than before, because just like before, the result of the trade is the fact that we get to keep that original cash flow from selling the Errant Condor, but we keep so much more profit this time that the comparison is almost ridiculous. And that's because the market pays you so much more for taking the risk that a huge price move on Amazon is about to take place on the day before earnings than it will at just about any other time. And this principle is true for many, many popular trading stocks as they approach their earnings release. Although because of Amazon's per share price, you won't normally get a 600-point range and expect to be able to make this much in dollar profits. But proportionate to a stock's price, these kinds of opportunities are available all of the time during earnings season. So what I'd like you to take away from today's video is the fact that earnings season affords you a huge opportunity to trade option strategies which richly reward traders who recognize the massive price increases that take place on options expiring after a company releases its quarterly earnings report. Professional options traders know how to sort through and select these opportunities and how to structure trades to leverage the unique behavior of options leading up to earnings releases like the Amazon trade we just covered.
Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.